Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're going to look at the economy in specific segments where we're going to look at oil and energy and how is that being impacted by the lack of mobility, lack of growth, what's happening in terms of the oil market. Then we're going to look at the U.S. broken down into trade, into updates in terms of some economic activity. And then we're going to wrap it up with China and just look at what is some of the Chinese data really telling us. So first, we're just going to dive right in and look at the BP comments. So we're going to break out next week and look at BP, Vital, what are comments, what are things happening? Because BP came out with a very big statement talking about oil demand may have peaked already. Now, I have a certain view on oil demand. But when I talk about oil demand, I'm talking about pure oil. A lot of times, like if you look at this chart right here, they're talking about oil demand in terms of oil, natural gas liquids, condensate, which again, I think that there is going to be additional demand on the NGL and condensate level. I think that we're going to see a lot of headwinds on the oil level in terms of just the inherent slowdowns in global GDP, the replacements as diesel gets displaced by propane, LNG, and some of these industrial areas. And we see natural gas just taking more market share from just distillates in general. So there's going to be, spits and starts in terms of what that looks like. Gasoline, again, I think we're going to come to kind of a net neutral once we shake out and we start going in terms of, well, people are moving from the urban areas into the suburban areas. So that's going to be more miles driven, which is true. But we also have, better gas mileage. We have people who are willing, based on the data we've seen so far throughout COVID, ordering more online, you're not going to the store as much. And there's going to be a question of how much of that is sticky. And I think that there's going to be more of it is going to remain versus not in terms of just simplifying the way we shop and just streamlining a lot of different things. So again, I'm more balanced on oil. So this is something that we can pick apart a bit more because they're making a big call on just green technology. And we did our rare earth show talking about how rare earth demand is going to go up. And by the demand going up, where we can get the rare earths, what is the price going to be? What does that do for nickel, lithium, and just the raw materials that are really driving, really necessary to kind of drive the show, is going to be kind of how much can we see this cost effectiveness come in, which is why some of these ideas are not really attainable. And one of the things that we're doing on the other side is looking at building a private equity fund, looking at infrastructure, looking at energy infrastructure, because we believe that there's a basket approach. It's not just green, it's green as well as liquids, and trying to get to some of this balance so that we can have a lot of sustainability and resiliency, not only in our grid, but in just the way we consume energy in general. So when we talk about that oil demand being, seeing those headwinds, we have to turn to economic activity and virus contagion overall. So virus contagion, again, starting to slow down. The question is going to be, what does the flu season look like? What does the fall and winter season bring? But here you can see that there have been some shifts up just in terms of economic activity. The U.S. has started to see a little bit of an increase because we're looking at the filled-in bubbles is where we are currently in terms of economic activity. The problem that we're experiencing and that we're starting to see is some of these headwinds coming into not only France, but also Spain, in terms of, you can see that even though they've moved to the right in terms of moved up in terms of more economic activity, they've also moved to the right as they've seen an increase in virus contagion, which again is going to put additional weight as you start to see some of this economic activity slow down. Japan is, for the most part, normalized. They're about 10% off of normal. Again, we don't think that's going to be something that we're going to see. We're not going to get too far past that. And the reason why we say that is because exports continue to be down year over year. We continue to see a pressure. But in terms of just virus contagion, you can see it's gotten better. So there's going to be some of these headwinds overall. The bigger things in terms of just obviously the inherent GDP size is the US, just based on the size of the bubble. You can see that we're obviously the largest country in the world. So that's going to weigh more on oil demand overall. What are runs going to look like? And that's going to put a huge crimp in terms of this oil demand recovery story. Now, when we look to the emerging markets, the two that we want to call out the most is obviously India and China, which we continue to talk about because they have such elevated storage levels. China was the biggest buyer from April to May, which we followed. We talked about it, and then the storage never went away, and that's why we kept saying, look, the physical market looks like it's going to be a problem, and the market didn't really care through the summer, but all of a sudden, September 5th, that people woke up to the fact that this is going to be a problem going forward on real price appreciation. So China has slowed down a little bit. Again, we're going to kind of hang within this, call it 85, 87 to 90%. And we are going to continue to see additional headwinds as we go through the remainder of the year, which is what we're going to talk about in the final segment. In terms of, there is some good data, but also there is some problems. What do those problems look like? How is that going to impact it overall? India is going to be a problem as you see virus contagion increasing, and it's going to put an additional overhang, as we've already heard about an increase in refined product exports. We've seen refined products just demand overall start to creep a little bit higher, but we think that that's going to pare back now that we've seen the contagion increase, and we've already seen runs starting to get cut. And just understanding when we say that, what do we mean? We have to look at the new COVID cases, and you can see that they continue to increase. They continue to go in the wrong direction, which is leading to the new active cases. The lockdown index is going to remain at that 81 to 83, which just means that people are going to have curfews, try to limit the amount of exposure, which is going to push down on just inherent consumer sentiment and just what is happening as people move around on the congestion index. You can see it's starting to get worse. It got a little bit better, and we think it's based on this is a little bit older. We're starting to see it roll over. And then retail and recreation, all of these things are starting to be impacted based on the contagion issue and the fact that people are starting to slow down within the area. And then when we shift to the global driving data, you can see that we're kind of stuck in this down 22% level. And it's coming from different components. China has gotten a little bit better. The US is, again, we talked about flattening out. Last week, we talked about that September 4th average had an uplift from Labor Day. That uplift is starting to go away a little bit, and you're just kind of seeing things stick around this, let's call it, yellow to orange in terms of just where the weight is. And just given the uncertainty in the market, the lack of employment, the problems with spending, which is what we're going to talk about in the US section, again, that's going to be an overall overhang for total gasoline consumption when we look at it from an aggregate on a global level. And then, in the EIA show, we talked about U.S. flights. We talked about global flights. Well, this is just looking at Europe. You can see that the April estimate, which we said, look, guys, everyone is very excited for April, and we didn't really understand why, just given the overhangs, not only on just consumer spending, but also what are businesses going to say? What are businesses going to do? What is the data telling us? And the data was telling us that we were going to see a slowdown. And that's where we see, the April estimates, again, we knew that we were going to get a bounce hard off of the bottom. It's just that bounce hard off the bottom got kind of suckered people in where they said, look, it's going to continue. Look at this, V-shaped recovery. And now the September estimates are finally starting to normalize a little bit, where you're starting to see us trend down. We're seeing this call, we've talked about it between that 65%, 55% down. And that's where we think we're going to live as we go through the remainder of the year, which is again being represented here. As we talked about in our OPEC show, in our economy show, we believe that the estimates for total oil demand were overstated, and we're starting to see these numbers get walked back from OPEC, the IEA, EIA, and we're starting to see some of this normalization as this 10% down starts to really get baked in. We think it's going to be a little bit greater, something closer to 12 to 15% as we go through the remainder of the year, especially as we see some resurgence of COVID and some people changing their inherent movements. And this is just a good backdrop in terms of where 2Q was. We're down, they have us down about 20 million barrels. We think it was much close. At peak, it was closer to 50. But again, then we had that hard bounce off the bottom. So that's something that will continue to kind of drift lower as the data gets formalized. But realistically, it comes down to what does 3Q look like? And it's something that we still think is going to be below or just below 90. And then 4Q, again, we don't see that kind of bounce. We think we're going to, 3Q and 4Q are going to look very similar in terms of some of that normalization, which gives us to the average of about 10 million barrels a day lost. The problem is we think that it's going to be something a little bit lower than that. And we don't see the same type of recovery as we go into 2021, only because we continue to see a huge amount of storage, like diesel, gas, oil storage on a floating level is at 31 million barrels as of September. Again, when we look at end of August, we were at 27.6. So we've already seen an increase of almost 4 million barrels in terms of storage. And we just continue to see that going higher and higher. Just to give you an idea, August 14th with 23.6. So it keeps moving in the wrong direction as we keep, trying to hone in on the seasonality and where we sit in terms of shoulder season. That's going to continue to trend higher, which again is going to put pressure on not only U.S. exports, but also European exports, and just what is that pricing in the market. Jet fuel is following the same trajectory, obviously, because we see additional issues where we're sitting at about 50 million barrels of storage. Gasoline is one that has gotten a little bit better, and again, that's starting to move through, and it's just because European product is starting to get back into motion. But the problem is it's starting to get stuck in West Africa with very little movement. So the reason why we talk about refined products is because we're seeing this build on the refined product side, which essentially just drills down and just means that it's going to be a bigger overhang for oil in total. And that's when we start to look at the OPEC production numbers. Now that we've had some official data for August, it's gotten refined. We see that the UAE actually saw an increase of about 240,000 barrels and came in at about 3.11 million barrels a day. So the secondary sources, and this is where it starts to get interesting, because secondary sources put them at about 2.7, but when you start to look at some of these additional sides, it's actually a little bit higher at about 3.1. So this is creating a certain amount of strife because they were about 520,000 barrels a day above their compliance target. Now, that is a bigger problem when we're starting to look out, because the country exported 2.7 million barrels, and they actually had accumulated stockpiles of 115,000 barrels a day. Again, all of these numbers are not bullish in terms of increasing supply, more storage within the country, and just more exports, again, trying to take market share, protect market share. And the question is going to be how does OPEC treat this? How does the GCC treat this? Are they forced to cut more? Are they forced to make up for this? Because right now you're starting to see countries get concerned about balance sheets, need the petrodollar, need foreign reserves, need to do something to try to help my economy. And that's why we continue to see pressure. Obviously, Nigeria failed to reach their targets. Iraq failed to reach their targets, even though they cut a little bit. Again, the fact that we have continued non-compliance, and a country that was part of not only the compliance, but also the voluntary cuts, is going to be a problem as we look at just overall OPEC mandates. And then just looking at Iraq overall, so far September is trending above August, which again is the wrong direction. They're supposed to be cutting. When we look at Iraq trying to meet this compliance level, and when we look going forward, they've asked for more time to be compliant, softening some of these cuts because they just don't have the ability to do it. Not so much because they can't, it's just they have autonomous regions within the Kurdish nation, the semi-autonomous nation, and that they have to deal with. They continue to export to try to bring in those dollars, which again is going to be an issue overall. So when we look at world oil demand, you have to consider where is the world oil demand as we go into 2021. Because we've seen what 2020 looks like. We've seen the non-compliance. We've seen the growth in some of this supply. Well, is there a way to absorb it? And here you can see that OPEC took down their estimates for 2021. In 1Q, they took it down by almost 1 million barrels. Again, just looking at how we're looking at the data, we're trying to be very data driven. We continue to see these numbers getting walked back and additional overhangs, because when you look at the jet fuel market alone, the jet fuel market alone accounts for 8 million barrels a day. So when we're 70% off of normal, you get an idea that, that's more than that's almost, jet fuel alone can essentially absorb what this drop is. That doesn't include, diesel, industrial slowdown in production. These are issues that are going to continue to weigh on kind of where we go going forward. And then when we start to look at the U.S., what is the U.S.? You can see the estimates here. We talked about it in our Frac Spread show. We don't see much in terms of 2020. We think that this numbers make sense once you start factoring things in. The problem is 2021 they have growth. We just don't see the same kind of growth. So that's actually relatively bullish if you want to think about where we sit overall. We're going to start to get a little bit better in terms of projecting this, and we're going to have a new report coming out looking at the production numbers, because we did do that. We did do the work. We have an article coming out in AOGR looking at the demand side for service equipment, the supply side for service equipment, and we're going to start to hone in on why do we think some of this production is going to be an overhang as we go into 2021, as we've talked about, needing at least 150 oil spreads, and we're just not there right now as we sit there at between 85, 87, and we don't see that kind of activity starting prior to 2021. So you're going to see some of those declines accelerate as we go through the end of the year. And then China is the one where, even though we think they're a little lofty in U.S. supply, we think they're a little lofty in Chinese oil demand. And that's one that we're going to go through in a bit more detail in the final section. But the one that we think it does make sense, we see an increase in LPG and naphtha demand, which, coming back to oil demand overall, it's just we're going to see that overhang in terms of oil, but we do think LPG, naphtha, LPG being liquid petroleum gas, which is a mixture of propane and butane, those two things will see growth. We see new chemicals coming online. New chemical facilities will continue to absorb this. The gasoline and diesel oil is the one where we start to see some problems overall, and we think that we're just not going to see that kind of growth, which again is going to be a problem as we go through the remainder of the year, because we saw that again, that pop off the bottom in 19 into 20. And it's just, we see those issues as an overhang as we go forward, which is just going to be a problem when we consider, where does oil pricing go and what does refined demand really look like to absorb some of the glut that we described earlier.